This is Options Impact Video Education Series Tier 2 Outright Option Positions, Cluster 1 Long Option Positions. This presentation is Understanding the Long Put. Now I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading, and you can get a copy of that by calling 1-888-OPTIONS. So now we'll be discussing understanding the long put. The long put is a fairly basic strategy as well. If a trader understands a long call, it's not a very big stretch for the trader to understand the long put. I like to think of it as the same thing, just kind of upside down. Instead of wanting the stock to go higher, here the stock wants to go lower. Sometimes understanding the long put can be confusing for new traders, but with a little diligence and with the help of this video, traders will be able to understand the long put with ease. All long options have limited loss. The long put has limited loss and substantial profit potential. Unlike the long call, the profit potential is not technically unlimited because the stock has a lower boundary. The stock can only fall to become worthless, not into negative territory. So because puts profit as the underlying stock falls, and because the stock can only fall so much, there is a limit to the profit potential, but it can be highly, highly leveraged compared to the investment made into a long put. With the long put, you can only lose what you pay. Compared to a trade like a short stock position, the long put can be highly leveraged when one takes into account the margin that one would have to post in order to carry a short stock position. Further, compared to a short stock position, the long put has limited risk where a short stock position does not. These are tremendous benefits for the long put. These benefits come with a trade-off of their own. As time passes, long options, including the long put, loses value incrementally each day. This is referred to as time decay or erosion. A trader would consider buying a put if the trader is bearish, expects the stock to move lower. A trader would buy a put if the trader expects future volatility. Again, because the option will suffer time decay each day as time passes, the trader must have a move to the downside, that is into bearish territory, as soon as possible so the trader doesn't suffer too much of the effects of time decay. A trader might seek leverage or margin benefits in comparison to the short call, and the trader wants to have limited risk on his or her position. Now let's look at an example. This is a screenshot of Visa. Prices are not current, but imagine a trader is bearish on Visa. The trader may consider buying the March 115 puts on the offer right here, $3.15. So imagine the trader has purchased the Visa March 115 put at $3.15 and holds the trade until it expires on March expiration, the Saturday following the third Friday of March. If the stock falls and the stock is trading below 115 at expiration, the put will have value. The trader can sell at 115. If the stock is below 115, the trader can sell at a higher price than the market. That means the put has intrinsic value. If the stock falls greatly, the trade can have substantial profit opportunity. Now, if the stock is trading above 115 at expiration, then the option would expire. If the stock is trading above 115, the holder of the put would simply not want to exercise and sell below where the stock is trading. If the stock is above 115 at March expiration, the trader can lose the entire $3.15 that he or she paid for the put. Now, let's go back to the scenario where the stock is trading below 115. The put will have value if the stock is below 115 at expiration, but the trader may or may not have a profit. The trader must consider the break-even, which in this case is $111.85. The formula for calculating the break-even of a long put is the strike price minus the premium paid. And here's how we can think of that. If a trader owns the 115 put and has paid $3.15 for it, if the stock falls below 115 at expiration and the trader decides to exercise the put, the trader will, by definition, sell the stock at $115 a share, but the trader must consider the fact that he or she paid $3.15 for the put itself. So we need to subtract what was paid for the put from what the trader would collect when he shorts the stock by exercising the put at $115. Therefore, the trader effectively would sell the stock at $111.85. That becomes the break-even. If the stock is below the break-even, the trade is profitable. If the stock is above the break-even at expiration, the trade may have value, but is not a profit for the trader who bought the call at $3.15. The long put is a bearish strategy. When the stock falls, the trader makes money. When the stock rises, the trader loses money. The long put can be thought of as a substitute for shorting stock. It has advantageous leverage. It has advantageous margin requirements. And it has protection compared to shorting stock. When a trader shorts stock, if the underlying stock rallies sharply, the trader can lose a lot of money. The trader theoretically has unlimited loss potential when shorting stock. When a trader buys a put, the trader can only lose what he or she has paid for the put. The long put, like many option strategies, has advantages and disadvantages, but in its simplicity and elegance, it can be an excellent alternative to simply shorting stock. This has been a presentation of Market Taker Mentoring.